All right, so thank you, all of you that have been able to stick around. I know it's the last paper of the day, so I'll hopefully try to keep it on time and everyone can get to dinner or drinks or flights or whatever you may have to. So this is joint work with Mark Gervaisi and Mark Jansen. I do apologize for some of you from Georgia State. Mark presented this paper, I think, on Tuesday there, so don't take offense if we haven't brought in all your comments yet. That's more a reflection about the time than our view of your comments. But if you have future ones, we're happy to hear them too. All right. So, where are we kind of coming from in this paper? We're looking at consumer credit markets, and we're thinking about it as there's really kind of two sources of, think about forms of lending in these markets. So the first is asset-based lending, or what you can think about as secured lending, where it's linked to some physical collateral. The physical collateral, the value of the asset that you're financing with the loan. So you can think of this as a mortgage. So you're kind of going out and buying a house. The other form that we're going to think about is cash flow-based lending. So this is going to be supported by the future borrower's income, or what they can pledge of their future income. That's the recourse of the financing. So in this sense, you can think about this as unsecured lending, so credit cards. Right, so what we're going to do is think about what happens in situations where you can have access to both of these forms of lending, both of asset-based lending and cash flow-based lending. So we're going to assess the relative importance of these two, especially of cash flow-based lending, and whether low-income borrowers rely more on asset-based or cash flow-based lending. So how are we going to do this? Well, it's important in our sense because it allows us to answer certain questions, right? Why would you care about whether you can have asset-based lending or cash flow-based lending or secured lending or unsecured lending? Well, it tells us the importance of the pledging of human capital, going to the theme, I guess, of this part of this session. It also can potentially relate to how economic fluctuations affect access to credit markets. So if there are certain aspects of economic fluctuations that then relate back to the value of these underlying assets that you're pledging, whether it's the asset-based lending or it's the future borrower income, that's varying. That can cause differing access depending on who's dependent on it, low-income borrowers versus high-income borrowers. Finally, we can also address certain questions related to financial innovations. How do they aid or hurt low-income borrowers in thinking about disparate impacts? So in this sense, you can think about there's recent, let's say, regulation that's changed the amount of risk weighting in banks, how much risk weighting there is on unsecured versus secured lending. Good.
Just a clarification, so these not be mutually exclusive, right? Because like if I think about mortgage, even though it's a secured loan, they still verify my income or whatever, so.
Yep. Yeah, so these are, I mean, they're not mutually exclusive. I mean, if you think about a credit card is more of a unsecured lending. So I mean, in that sense, I don't think that they would have recourse necessarily to the assets underlying it. But yeah, for a home loan, you can think about, well, they do have the asset derived, but they are going to check your income to make sure that it's verified and that kind of thing. But this kind of gets into what we're thinking about here is these are intertwined.
So just like pledging human capital, you mean just continue to work.
Continuing to work or other forms, basically continuing to work. You could think, I mean.
No, that's okay. My wife views herself as an intertemporally kept woman now. She wants me to keep working.
Okay,
So that's fine.
So I mean, if you're both on the loan, as you might be, in our setting where you're buying cars, you might buy the car together and your both names are on the loan, then if you're working, that's perfectly fine. So as you're saying here, these are intertwined, which presents a challenge because it's hard to potentially separate these two. When you fill out the loan contract doesn't assign a weight to the ABL versus the cash flow-based component. You can't look at the contract and say, well, how much are they thinking about of this and how much are they thinking about it of that? So what we're going to do is try to use an experiment, right, to distinguish these two types of lending. Experiment and natural experiment. We're not doing any type of, in a lab or anything like that, so I'll try to be specific in that use of the term. To distinguish these two types of lending, so how are we going to do this? We'll first develop a very simple theory, very simple kind of toy model of this type of lending to market, and show that there can be differing responses to changes in the economic durability of the collateral. So shock to the value of the collateral, how does that affect the relative use of this cash flow-based lending versus this asset-based lending for different kinds of borrowers. So we'll get differing predictions depending on which one depends on it more, based on a shock to the economic durability. And then obviously what we're going to want to do is test this in the data in some way. So how are we going to do that? We're going to exploit model discontinuations and vehicle make discontinuations. So we're going to think about this as a shock to the underlying economic value of that collateral, the underlying economic durability of the asset. Now, why is this shock we think is a good shock? Well, it doesn't directly affect the car in terms of the actual functioning of the car. Right? The car still is the same car, as the same underlying car as it was the previous year. It's a year older, but now we have a shock to the future value of it. Right? How does this come in? Two potential mechanisms. First, parts availability and servicing expertise are going to degrade over time. If you're used to working with a certain type of vehicle, that's not going to be there anymore. They'll stop making parts for that vehicle, these parts that are continually from model year to model year. So you're going to have to go either to junkyards to get the new parts or other things, so that's going to degrade over time. And the decent vehicles can lose some cachet. You just may not want to drive a vehicle that's discontinued anymore. You say, well, I just don't want to be associated with that car. This can hurt the future sale value of it. Right? So if the lender is going to go collect on that car, they're going to get a lower value of it in terms of the collateral. But
how should I think about depreciation here?
The what? Sorry?
Depreciation.
Depreciation, yeah. So this is what you can think about this. This is a shock to the depreciation. We're speeding up the depreciation. So I'll talk about this when I show the results. Sure. But it's a roughly equivalent to making the car 6 months older, is what the shock represents. Go ahead.
Should we think about these as unexpected shocks or unexpected shocks?
Right. So, I don't remember is this on. Okay, let me just talk about it here then. So it's the question of expectedness. So clearly this is a decision made by the manufacturer to discontinue the car. So when you think about it, it is endogenous in a certain extent from the manufacturer's point of view. They're choosing which cars to discontinue. They're choosing which makes they want to stop making. However, from our point of view, it's exogenous to the borrower. Right? So the borrower is not affecting that. And it's exogenous to the lender. The lender is not making that decision. So it's exogenous to those two. And I'll show you charts that there's no anticipation of this. So when we look at things like parallel trends, we don't see any trends comparing non-discontinued vehicles to discontinued vehicles. It's flat all the way through. We don't see anything up to the point, and then we see a big drop, let's say, in the value of the car. Does that answer your question?
So I bought a car which I knew was about to be discontinued. I don't know if this is going to matter for me.
So what we do is once they announce it, that's the shock, right?
Yeah, but
so,
in a sense, I'm that type of consumer, right? So doesn't care. So
there might be something that if you're very closely following the trade news, you might be able to get in there. Okay, I know about this slightly before other people have started to discover. That could be going on. So that we can't rule out completely. We don't see any, pre-announcement effects on it in that sense, that they're not tracking it super closely in that regard. We don't see any response to prices. So we can rule that out, at least from our view empirically. There can still be some of that going on. I mean, we can't completely say.
And you're not looking at collector cards where, you do that for something stupid like baseball cards that Americans care about. That'll actually increase the value of the baseball.
This does happen, that's a fair point. This does happen for certain types of cars where all of a sudden they stop making it and it's become this kind of collector item, or it's a rare type of car and that you're not going to be able to access it. The vast majority of our sample is going to be your kind of run-of-the-mill, everyday, get to work, medium-sized car or compact car. There's not, well, I'll talk a little bit more about the sample, but this is not super high-end cars or anything like that. Okay. So, we'll build up this stylized model, just give you a preview of the results in case I don't get everything. Contrasting these empirical predictions, and then we'll use this vehicle model of discontinuation. What we find is that CFBL, this cash flow-based lending, is going to play a especially large role for low-income borrowers. They're more dependent on it when they're given the situation to use these different types of lending. And this can explain some unexpected market features. So when we look at the shock to this collateral value, if you have just a traditional model that's based on only asset-based lending, you wouldn't be able to explain these types of results. Right, so we can use this model to explain what we think are kind of, at a first thought, might be something a little bit hard to understand, that this can help explain what's going on there. And this is going to stand in stark contrast to the corporate lending market, where you actually get the opposite results. In the corporate lending market, what you find is that resource-constrained firms, so firms that have trouble getting financing, actually are going to have to rely more on asset-based lending. So So we think this is like an important distinction here, thinking in this role of household finance, when we're often thinking in finance, especially corporate finance, about firms, how firms are behaving. This is very different than how households were behaving, at least in this regard. Okay. So let me jump into the model. I'll keep everything really simple. I know it's getting late in the day, so I won't kind of go through everything in high level detail. So it's a very simple stylized model here. So let me just put that out there.
Sorry, so is it just the value of the asset that is changing, or is it the loan amount that the borrower would also change?
Yes, so that changes naturally as well. So both are, so the value of the collateral is being shocked, but that's obviously going to affect the value of the car, so you're going to borrow less. Right, so you're changing the amount of financing, and so what we'll look at is various ratios. We'll look at things like the payment to income, loan to value, the down payment that you make. Not necessarily because it's somewhat makes sense. We'll validate that this shock actually has an effect. But yeah, since the amount of the value of the car is going down, the loan amount is also going to go down. Okay. Any other questions? Yeah, go ahead.
So do you think that the price changes like forever? I'm just thinking, in my experience, I bought a car. It was just the last year's model. They had to get it out. I feel like I maybe got a discount in December because I was buying it, and maybe a year or two after, it's been so long. There's no it's just the old model. So do you think that there's kind of
So we do see that there is a persistent kind of longer range. I'll show you the event study chart, and you'll see that there is a persistence. It does come back a little bit up in this specification, and we think that is partially, you get a shock, and then if you think about a depreciation curve, you're kind of moving out along the curve, and that's eventually going to flatten out. Very rarely, cars don't, even a very old beat up car, unless it's completely non-functional anymore on blocks or something, it still has some value, so they don't go all the way to zero, so they do flatten out now. But we do see that it's a persistent effect. It's not like, oh, it drops and then comes all the way back up, a year later. It's not just that.
And there's also a big distinction between whether it's discontinued in terms of repair parts.
Yes.
That as distinct from that particular shape of the thing. So you're talking about fundamental discontinuity.
Yes. So I mean, you can think about, year to year, there's some model changes. Obviously, they update the car a little bit, but we're thinking they just stopped making that altogether. So or in some of these cases, it's a brand that just stops existing anymore. So you had Pontiacs, then you don't have Pontiacs, right? And then any part that's not easily transferable from, sometimes there's, there's some parts of the car, the oil filters and stuff like that, they're usually transferable across models, but there's many other parts of the car that are specific to that model, right? They can't necessarily replace that. Okay, so into the model here, the model of borrowers, there's two types of assets. You can think about a durable asset and a less durable or non-durable asset. There's going to be some markup for the seller, so this is to the car dealer, what they're earning their profits on it. There's two sources of financing. There's going to be this ABL, which is secured by the residual value of the asset. That's the physical capital. Then there'll be cash flow-based lending, which is secured by the borrower's future income, their human capital. We can think about there's some ratio or how much they can actually pledge of the residual value of the asset and the residual value of the future income. So both types of these lending are subject to some limited pledgeability constraint. You can't pledge the whole value. This is just a standard. The lender can't collect the whole value of the car. They're not going to be able to get all of your income as the borrower. Finally, we have this verifiable assumption we can test in the data that the low-income borrowers only can afford the non-durable good. So we're going to have this aspect to it, and this is going to represent the discontinued vehicle. So we'll check in the data, which types of borrowers are buying this good, and we'll find this shouldn't necessarily be that surprising, that lower income are going to buy the good more likely when it drops in price. But we'll show that as, we'll test that assumption most directly.
Like Philippe.
Yeah, exactly. Yeah. Good example. Yeah. Okay, so what are the empirical predictions here? So first, thinking about down payment. So if the income is sufficiently pledgeable, your future income, that coefficient on that is sufficiently large, then the down payment is going to be higher for the low-income borrowers purchasing the non-durable asset, relative to that for the high-income borrowers purchasing the durable asset. Opposite if otherwise. So what is the basic intuition here? You get a shock to the durability, that's going to lower the collateral value. So if you just have a model of asset-based lending, so for instance this Rampini 2019 AER paper, this is going to reduce the down payment. It's less than 1-to-1 due to the collaterability constraint. So what's the contrasting prediction here? Once you include this cash flow base, this unsecured portion, The low-income borrowers are going to have less income to pledge. This means that they're going to have a reduced portion that's related to this cash flow-based lending. And in return, they're going to have larger down payments if they could pledge more of that income. Right, so this can counteract this composition effect of which types of borrowers are buying the asset, can counteract the direct effect related to the price if they can pledge enough of their income. Okay, so that's the first prediction related to down payments. The second prediction we can think about is related to the loan to value. So again, if low-income borrowers rely relatively more on CVFPL, so this one we're thinking about the degree which each type of borrower depends on that, then the LTV ratio is going to be higher for these low-income borrowers purchasing this non-durable asset, again, relative to the high-income borrowers purchasing the durable asset, opposite if otherwise. Again, what's the intuition here underlying it? If the low-income borrower is going to rely more on the cash flow-based lending, a larger portion of their loan is coming from, again, this cash flow-based lending. This is going to offset the lower residual value. So the denominator is dropping, that's the residual value of the car, but they can rely more on this cash flow-based portion, that's not going to drop as much, causing the LTV to increase. Okay? Again, if they're less dependent on it, it would go the other direction. If they didn't have any dependence, this wouldn't matter here. Right? Because again, if you go back to a model with just ABL, the only thing that determines the LTV ratio of the asset or the borrowing here would just be determined on the pledgeability of that asset. Okay, final one, just related to PTI. This is going to go the opposite direction here. The PTI is going to be lower for low-income borrowers, again, as long as they're more dependent on the cash flow-based lending. Again, just a quick intuition, don't want to spend too much time on it. It's very similar. The low-income borrower purchased a less durable discontinued vehicle. Right, this goes back to your question. The debt financing from that collateral is going to be restricted. They're going to borrow less than. This is going to give them a lower PTI for the low income. So their payment ratio is going to go down, or payment to income ratio is going to go down. Okay, so just to summarize it in one kind of picture here, we can kind of think about this as the way we're kind of thinking about it in our. This is not a calibrated model. Again, this is very simple, 2 types, 2 periods, everyone's risk neutral. I don't want to get in trouble for saying anything too extreme here, but you can kind of think about this allows us to think where in this parameter space we are. Right, so on this bottom axis here, we can think about increasing the economic durability of the non-durable asset. This is the model going to be increasing the dependence on ABL. The smaller difference there is between the types of assets, the more you can depend on this ABL. On the y-axis here, this is going to be the pledgeability of your income. Right, so as this go up, you become more pledging of your income. And then what we can do is think about comparing these different quadrants, and what we're going to find is that we're going to be up here in this quadrant here, where you're going to have higher LTVs and down payments and lower payment incomes. Right, so we can use this kind of setting to test where we end up, and that allows us to say something about what is the pledgeability of the income in this market, and then what is this dependence of the low income versus the high income borrower on cash flow based lending. Okay, so in the last, I guess, 20 minutes of the presentation, let me just jump into the data then. So what are we going to use to actually test this? So we're going to use as a sample of car loans. We have roughly 340,000 car loans from the US. Again, we think this is a relatively representative sample. This is generally going to be more, not quite subprime, but more subprime-ish type borrowers. So these are not, super high-end cars, as I said. These are these are used cars. The mean value of the car is going to be roughly around $13,000, the median roughly 13 as well. Other kind of important characteristics here, the down payment on the median's around 800, the mean's around 1,000. That gives you a rough idea of the changes once I talk about them, how much that's changing in percentage terms. There's not much movement here. I'll talk about this a little bit. The model, we don't really discuss it at all because it's a 2-period model. We'll do a little bit of a test on the loan term. But these are relatively standard, 6-year loans. So not that long term, 6-year loan. Finally, the monthly income in our sample, the median's around $4,000. Right, so these are, again, not super high income earners, but we do have some variation in the data. the 75th percentile is around 5,300, the 25th percentile is around 3,100. So we do have some variation there.
LTVs are really high, right? Like even the 25th percentile LTV is greater than 1. Do you see a lot of strategic default?
So that's a general thing for car loans, is the LTV is going to be high, right? That's partially
drive out of the.
Yeah, it's as soon as you drive off the lot. There's a big difference between the value of the car that the lender cares about and the price of the car that you actually have to buy it for. Because the lender cares about exactly that. Once you drive it off the lot, that's what they can repossess. Right? So that's the value that they're putting in for the LTV calculation. The price of the car that you're going to pay is not taking into account any type of that, immediate depreciation, which is not really depreciation. It's just that there's some profits that the dealer is making on it. Right, so the vast, it's very different than housing, where you generally see LTV ratios less than 1. You would never get, it's very hard. I don't think most mortgages would ever have an LTV ratio greater than 1. So immediately there, we know that there's at least some cash flow-based lending going on, right? Because you have an LTV greater than 1. Now, your answer regarding strategic default is, I don't know if I can fully answer that question, to be 100% honest. We don't have an ability to track their incomes of the borrowers after the fact. So I can't tell whether this is default due to loss of job or default due to medical expense or something else coming up. What I can say is that we do see there's one way that cars often default is if the car gets totaled. Right, the car gets completely totaled, I still owe money on it, I just stop paying it. So I'll talk about a little bit about recovery values towards the end of the talk. So that's I can comment on it a little bit, but I can't really say, is that strategic or not strategic? It's hard for me to exactly distinguish those two. Okay. So what is the actual specification that we're going to run? We're going to run a relatively standard diff and diff here, have various dependent variables. Then we're going to look at this period after you get discontinued. That's going to be our treated set. We'll run a wide variety of fixed effects. So we'll run at the model times vintage year level. We'll run at the transaction year fixed effects, dealer fixed effects. We'll also interact the year fixed effects with the things related to the parent company. There's other papers that looked at, okay, the parent company might not be doing that well. That may cause things to happen in the car if you're worried about future warranties and this kind of type thing. So we'll try to control for that with that interaction. So what are we really thinking about here? We're comparing cars within the same period, absorbing any non-time varying attributes related to the specific model, vintage, year, and dealer. Right, and then we're going to cluster everything by make. So at a relatively high level, or not that granular level of cluster. It's kind of the make of the car, so it's GM or Chevy or Ford. Right. Okay. Make sense?
So you have heterogeneous treatment effects by model and year, right?
Potentially, yeah.
Right. Because your coefficient varies, not treated will vary by model and year, right? You put J and T on the coefficient.
Oh, yeah, that shouldn't, sorry. That's,
so that's
yeah,
the same coefficient.
Yeah, it's the same coefficient. That's just a typo.
Okay.
No, that's a typo, yeah. So it's the same, we're treating it, so we will, it's not in the presentation. We run these tests where we do all this kind of newer diff and diff stuff where we stack everything to worry about this heterogeneous treatment effects across years. We see very similar results when we do this stacked and running everything with interacted cohort level fixed effects. So there is some concern when you have heterogeneity with staggered treatments and this type of thing. So we try to, when we do that, we have lots of never treated, so it's not a huge concern, but it does show up as a potential concern. So we run these stacked regressions, we see very similar results, which hopefully deals with that somewhat. So, but yeah, that's a type. Okay. So first, just how does this shock work? So we'll look at this in two ways. What is the shock to the vehicle wholesale value? This is, again, the value that the lender's considering. And then we'll look at that rather than the dollar value, just looking at it relative to its price when new. Right, because you have different types of vehicles here. Right, so we'll run this with and without various controls, with and without various fixed effects. You see a relatively, robust result in terms of, let's say, in terms of scale and price here. It's a roughly 3% shock to the value of the car. Okay? In dollar terms, it's roughly around $300 here, which if we go back and look at the set of vehicles, that's again, works out to roughly 3%. Okay, this is the standard diff and diff plots for parallel trends. again, this is just plotting the individual time coefficients here of the treated group. We can see, again, nothing really in the pre-period. This goes back to questions about announcement or any type of anticipation effects. We don't really see that. We do see a drop in the immediate period after. Does rebound. This gets to your question a little bit, a little bit, doesn't come all the way back. And we think of this as, again, that you're kind of moving along the depreciation curve. Okay, so that's just to validate that the shock has some effect. We can also then, instead of just thinking about the actual value of the car when it was purchased, we can also think, what does the lender actually recover? Does this show up down the road? And we can look at the recovery percent. And again, what we find is for discontinued vehicles after they've been discontinued, we see lower recoveries by the lender. So it's a roughly, anywhere between 1.8 and 2% lower recovery. So this is after the initial shock. Right, so that initial shock is going to drop the value of the car when they're purchasing it. And then if they do default on the loan down the road, we still see that they're going to recover that on top of it. Right, so the actual recovery in that, relative to where it was before the discontinuation, you could think about it as, let's say, 1.8% lower recovery plus the initial drop in the value of the car. Roughly 6% there.
But is it possible that the people who default before discontinuation versus after are different because people who purchase the car knowing that it has been discontinued may have different incentives to default?
Yeah, I guess, okay. So if you think there's some strong borrower heterogeneity there outside of the control variables that we have, and then you're going to say, well, there's these unobservable aspects, and then they're going to be more likely to default. When we look at default rates, it actually doesn't change at all. Right? So there's very little change in the actual default rate of the borrowers pre and post, but we do see differences on recovery. Again, this might get back to your question about your strategic default, that kind of thing I can't comment, but at least on the actual default rates, we don't see much effect there.
Maybe you can look at composition of borrowers who default if you have information on that.
Yeah, I guess we could look at that ex post, kind of where you are. I don't remember. We have information on recovery yet. I'll talk about that, but I don't necessarily have information about other borrower attributes at that time. But
just on those, it might be useful if you've got this to sort of say, how many months before discontinuing the car,
yeah.
the thing was purchased, because it was purchased maybe that there's a good 6 months, and then just some anecdotal data on how soon the news came out beforehand, rather than just the snap day.
Just to kind of address this, how much room was there to play these kinds of little games?
Yeah, I suspect you're probably fine, but that way those are completely legitimate questions. If people did it 5 minutes before and they knew, and then there was news reports and so forth.
Yeah. I mean, this is not stocks or something, so it's not like you can sneak in and buy it right before. There's some kind of lag, and you find out before the dealer does. But yeah, I think that's a good advice. Just take the anecdotal and just say, look,
There have been scandals in the baseball card market. I mean,
That's fair. That is fair. There are scandals sometimes in these markets. So. Okay, so this one again we think is relatively straightforward. We look at this 2 different ways. We're going to look at the bottom quartile, let's say, of borrowers, or we actually see lower income borrowers. It's just an indicator variable. When we run it with log income, we also see that less wealthy borrowers are lower income borrowers, I should say wealthier, I should say income, are more likely to buy these vehicles. Again, not that surprising. We saw a price shock, it went down. This should make us think that they're going to be more likely to buy these cars. Okay, this is just that plotted out for borrower income relative to the propensity to purchase. And again, we see this negative effect. It does flatten out after you get out here for some of our higher income borrowers. So most of our effect is coming in from these sets among the kind of bottom half set of borrowers in terms of income. Okay, as I said, we can also look a little bit at maturity. We don't really do this at all in the model, so I don't want to spend too much time on it, but we do see a shorter maturity on these loans. There's not too much variation there. Almost all loans are 6 years. We see a little bit shorter maturity. I wouldn't say too much about that. I mean, it's less than a month, but we just don't have very much variation there. And the model doesn't really talk about it, but that's somewhat intuitive that if you have less collateral to collect, you might have less maturity that kind of fits with other theories. Okay, so let me talk about now some of these contrasting predictions again, related to the down payment, the LTV, and the payment to income ratio. So first, for the down payment, again, the prediction was less pledgeability of income, a smaller down payment with discontinuation, higher pledgeability of income, a larger down payment with discontinuation, and what we again observe is a positive effect here. So it's roughly in dollar terms, anywhere between 85, depending on the specifications, and 68, or I guess 68 and 88, depending on the specification. So it's, I think if we went back, we said it was roughly $800 down payment, so this is close to, in this specification at least, roughly a 10% decrease in the down payment relative to the median. Again, looking in the kind of standard event study type plots here, not really much going on in the pre-period. We do observe a positive, significant effect in the post-period. Some variation, but again, it maintains into the future. Okay. So, again, just to kind of summarize this tells us that income pledgeability is an important feature of auto lending. Again, we can kind of get that idea from the LTV ratios, but you may not know how much. By having this shock, we can then say this is relatively important. Again, going back to our picture, that puts us in this kind of upper type quadrant. So lower income borrowers, despite having smaller future incomes, again, switch to borrow, still have to provide larger down payments to close the transaction. So we can think about this as, what are the constraints to borrowing and what are the constraints to buying a car, which is very important for, workers in America. This can be a potential scrape here, coming up with these down payments. Okay. So, turning to LTV ratios, again, the contrasting predictions, LTV decreasing with the discontinuation, versus if they're more reliant on that cash flow-based lending, it's going to increase with discontinuation. Again, we see a positive effect on the LTV. This is indicative evidence that their low income are more reliant on this cash flow-based form of lending. Again, roughly 0.02 LTV. The average LTV, I think in this case, was 1.29. So back of the envelope there, what is it? Roughly a 2 or 3% change in the LTV of these borrowers following discontinuation. Again, don't really see much in the pre-period. We see a spike. It does come down in the long run. This also gets back related to the flattening out of that curve. So this is kind of, think about it, it's the flip side of the price effect. So that might be somewhat expected as the depreciation kind of flattens out over time. But we don't see anything in the pre-period. We see the immediate effect in the post-period, which is kind of, again, going after the parallel trends assumption and that we actually are detecting something in the effect. Okay. So again, this implication here, first, is that, again, these low-income borrowers are more reliant on this cash flow-based lending. That's the evidence that we have. We think this is particularly interesting because these are the exact borrowers that have less future income to potentially pledge. Again, so these more reliant, right, as the debt is secured by their incomes, not by their physical collateral. Part of this effect is that they can't necessarily afford the more expensive car. They're having to buy the less expensive car. So they can't pledge that asset. So they have to rely more on their cash flow-based lending, on their future income. Okay. Finally, payment to rate income ratio here. We see again a negative effect here, where this is a contrasting prediction. If the low income are more dependent on cash flow-based lending, we should see a drop in the payment to income ratio. That's exactly what we observe. Again, no evidence of any pre-trends, drop afterwards, and maintains throughout. Okay. So that summarizes the basic set of predictions here. So in the last couple of minutes, let me talk about some other aspects. This gets to, I think, some discussions related to what happens afterwards. Right, so we do have some evidence on what happens to these defaulted loans. The lender provides us with evidence for what happens when they do go to collect. So we can look at the average collections versus on someone's income versus the average auction proceeds here. So this is, they can recover about $6,000 is what we get if you put these two together. Roughly a third of that is going to come from collecting on the income of the borrower, roughly 2/3 of collecting on the asset. Okay? So what we can do then is then say, okay, looking at among discontinued vehicles relative to non-discontinued vehicles, what is this effect going to represent? Can we actually observe some kind of difference here? So we do observe that they are going to collect on actual loans that did default, we're going to observe that they had lower collections, right? Roughly $600 lower collection, roughly 3.5% lower. But they're going to collect more on the income. Okay, so this is potentially interesting to us because these are exactly, as I said, we're lower income borrowers. So the collections on the vehicle is going down, right? But the collections on the income, so this is again the dollar or the percentage value, or the collections, this is just an indicator they get anything back on the income. Here that's going up by 6 percentage points there. These are lower income borrowers. So we're thinking about what is the effects of these collections, what is the effect of default. Again, can't say much in terms of strategic default here, but that these have bigger impacts than collecting on their actual income, which might be somewhat surprising to you if you're saying, well, these are lower income borrowers, yet we're seeing greater collections on their income. So again, thinking about this in a cash flow based lending as combined with asset based lending can help us explain some of that result.
Are there any borrowers who are like that low income that they are below the minimum collection income? So like there has to be a threshold income that a borrower has to have.
I don't. Okay, so I guess what we could look at is, was your income below that level when you bought the car? We could observe that. The thing is, we don't necessarily, there's no collections on you. We don't get to observe your income at that point, right? So we don't observe the borrower's income when they default. We can observe how much they collected on you. So it's possible that there was just no collections on you, but we can't really answer that question, at least with this data. Okay, so in the closing bit here, let me talk a little bit about the effects here, we think, on the kind of wider economy, or thinking about this kind of a little bit zooming out. So one thing is, again, I mentioned this at the start, how economic fluctuations affect access to credit. So one thing that we do here is we can look at, this is for ABS issuations. So this is for securitizing of loans. We can compare what's happened in different markets. So we can compare what's happened in the securitization of auto loans. This is thinking post-financial crisis, relative to what's happening in credit cards, right, which we can think, again, consistent of cash flow-based lending, and relative to equipment, right, which we can think of more of an asset-based lending. This is what corporations are borrowing on equipment loans, and then student loans, which is obviously going to be more of a cash flow-based lending. And what we see here is that there's this large increase in auto loan securitization. So one thing that we want to explore is how would this potentially affect which types of borrowers are able to get loans? Does this constrict the access to credit of low-income borrowers? If we think about once the asset has become securitized, it's more about the asset, or sorry, once a loan has been securitized, it's more about the asset than the future income of the borrower. What we do here is we're going to plot the equipment to total securitization. So we don't want to run it just on car loans. That seems mechanical somewhat to think about, movements in loans and that kind of thing. So we'll focus on the equipment to total securitization among the other types of securitization. We're looking at, again, excluding any type of housing and other stuff going on there. So this is going to be equipment. We can think about this as the asset-based loans relative to equipment plus credit cards plus student loans. Right? And so what we'll plot here is, here's the ratio of that. And then here's just, again, a very suggestive plot. We can't claim anything with causation here, so we're just going to talk about correlation. That we see when there's more equipment relative to total, so more asset-based lending, we do see an increase, right, in the highest quartile of income in terms of what they can get relative to the lowest quartile of income. So this is this idea that, again, as you move more towards securitization of these assets, this is potentially benefiting the credit access of higher income borrowers, potentially at the expense of lower income borrowers. Okay? So, again, this, you can kind of think about, I'm short on time here, so I don't want to really talk this too much. This can provide some things on inequality. If, again, you think about lack of access to credit, hurts the chances of a low-income borrower being able to buy a car, which is, again, key to kind of earning income in much of the U.S. Another thing that we can look at is just how much is actually getting financed by different tiers. Again, thinking about post-financial crisis, we see that for prime borrowers, we see an increase in the amount of credit that they're actually able to generate. For subprime and deep subprime, we see virtually no movement over time. Right? It's basically flat since the financial crisis, again, especially relative to prime and non-prime borrowers. They see an increase. We didn't see an increase here. We can think, again, for these types of loans, where you can depend on these two things. If there's policy related to this risk weights, let's say, about banks, that have to put greater risk on unsecured relative to secured asset, this could have the effect of limiting the access to credit for lower income borrowers that are more dependent on that unsecured form of credit. Okay, so let me conclude here. So again, the basic idea is we're going to show through this experiment, through a very simple model, through this shock to discontinuations, that low-income borrowers are more dependent on this unsecured cash flow-based lending relative to richer borrowers when they had potential access to both types, that this CFBL plays an important role in the auto lending market, and this can have different implications for various policy choices that regulators and others might be making. It's something we need to kind of consider the potential unintended consequences if there's differences in this dependence on these types of lending from different borrowers. So I look forward to the discussion.
So thank you for the organizers. I'm the last speaking person for organizing speak. Yeah, thanks for the presentation. Thanks for the organizers for organizing this wonderful conference in person. It's great to see everybody back in here. This is one of the everybody, exactly. This is one of the few papers that I've discussed where the title actually changed between the first version and the version that I got, and I'm not going to say anything about that. So just a very brief, if I have to summarize this paper, what do I think this is about? Basically, what is the relative importance of cash flow-based lending in car loans? So it's specific for car loans. It's a very specific population, so we're going to talk about that in a second. And what is the problem here in this paper? The problem is that they can't observe the composition of the collateral. So if they had ideal data, they would observe the composition of collateral. This is how much we would like to get back from the car itself, the asset. This is how much we get back from the cash flow or the income in that sense. Can we write a contract down that does that? And then that will be the ideal data set. And then we can do experiments actually in real time. So what do they do? And I learned a lot from reading this paper, is that they used car model discontinuations, thank you Glenn, as a shock to the car value. Now, I drive a car, I know nothing about cars there, so I learned a lot about reading in here. And then they wrote down a model, and actually the model in words in the paper I didn't understand, but the model in the appendix with formulas I did understand, so that was more helpful there. I just wrote it down in a summary overview. So what do they have here? Low income are more likely to buy discontinuous cars, and then basically an asset-based lending and the asset-based lending plus cash flow give the same prediction there. So this is more of a sanity check on the model. What will happen after discontinuation? Do we see that lower income are going to buy these cars more? The second is a low income have lower payments. That's not entirely obvious. It has to come from the model there. So the value goes down, but the loan to value goes up. And so something else changes, which is a down payment. So there's a lot of moving pieces in this paper. And that's actually my main criticism there, is that also in the results and in the paper, there's a lot of things that move at the same time. It's just difficult to wrap your mind around it. So I hope to give some help in that sense. So also there, they basically give the same predictions there. So you can't distinguish between these two types of, is it just asset-based lending, or is there some income component or liquidity component there? So 3 and 4 is where it gets interesting, because that helps to tease apart these two different predictions there. So if I look at the loan to value, then if purely asset-based lending, after discontinuation of a model, the value goes down, the loan to value would go down if it's asset-based lending. What do they find after discontinuation? It goes up there. And so that helps them to tease apart these two explanations. And the same for the down payment. And that was actually, I found it very intriguing, is that after discontinuation, it's a down payment that goes up there. Now, intuitively, let me wait for that for a second. And then the last one is, what happens if these people default on their loan? How much can you get in personal income? Now, when reading the paper, it's framed in personal income. It's not entirely clear to me if this is actually garnishment of income or if this is actually cash there. And so, if I then look at more down payments and more personal income or more cash, then I can also think of an alternative explanation where these buyers tend to have a more liquid wealth, a more cash type model. So is it like a really human capital where I can claim future income? Or is it that these people tend to have more cash that I can claim in the future? And that makes a difference there. It's not entirely clear what the prediction should be, so that's I couldn't make it up from the paper, which is why I put a question mark in here. But there is a clear relationship, a clear prediction from the asset-based plus model there. So that's the paper, my take in a nutshell. Household finance is exciting, and so this is one of those papers where I thought, this is why I study household finance there. So what I knew that, so this is the table of summary statistics, and there's a bit of a disconnect between how the paper is presented and how the paper is written, and then you actually look at these people. Or you look at the sample that's being used. And so what do we find in these sample characteristics? So down payment, $1,000 in cash. This is not your high-end cars. This is like low-value cars where people pay in cash. An APR of 20%. That's a lot for car loans there. This is not your high-income type of borrowers. This is a particular type of borrower. They default, if a default rate is 25%, which is 1 of 4. They have two types of bankruptcy, Chapter 7, Chapter 13, so it's 8% and 22%. This is a very particular sample. And if you read the introduction, how this is motivated, that this is a low-income people, they need their cars to go to work. These people, they need their cars to go to work. If they can't get a car and they lose their job, they're in deep trouble. This is a very interesting population from a public perspective. So, just to focus the paper, please make up your mind somewhere. This is not the general car population or the general driver population. This is a very particular point. 6% homeowner, a credit score of 532. This is not great. Let me put it like this. So if I think about this is the market for lemons, because that's the type of car most likely that they buy. This is the financing side of the market for lemons. Or if you wish, this is lemons buying lemons. So
You're an apple.
So the question is, are you an apple buying a lemon? That's the question. So I find this exciting. This is a very interesting population to study. Now, this may have consequences for how you motivate the paper and how for the type of policy consequences that you do, and this will make it much more interesting there. Okay, what is the big thing here? What is the value of a car? There. And you saw that during the presentation is that before discontinuation and after discontinuation, what is the value of this thing? Now, my bet is that both car dealers and the people who drive the vehicle have a very vague idea of what the value of a car is at any given point in time. The moment it drives off the lot, yes. The moment it discontinues, maybe. But depreciation seems to be a really big thing in here. So what do they find? So they find, I think, a very credible setup that the car value drops $300 after discontinuation, or about 3%. Now, the question is this a lot? Is this big? Is this small? $300, should I get worried about this? So, if I look at this 3% here, and the suggested interpretation is that if these cars are, say, all second-hand cars, for argument's sake, then what we're looking at here is rates of depreciation. Now, some of these cars are Toyota Siennas, which I drive. They go in like unless you crash them, they go into perpetuity. So they have a very low depreciation rate. Some of these cars are like drugmobiles. They have very high depreciation rates. So we have different rates of depreciation among these models. You could draw a model type for fixed effects, so that's good. But we talk about the rate of depreciation here. So we have a time dimension. And so what happens here is that these models are discontinued. And then after discontinuation, so what you have here is an average effect of the immediate shock, which is very clear in the data, and maybe a different rate of depreciation afterwards. And I'm not entirely sure that you correct for, that you could draw for that. So there's a time dimension here which might be important. Now the reason given is very mundane. If the car is discontinued, it may be harder to find spare parts and all that. Could it be that the very fact that the manufacturer discontinues a car is just, could be taken as a signal, this is a bad car. And again, this is against in the world of lemons here. So this is a really bad car. Now, $300, I don't know. So this is question 0. This is like the cheap shot here. Question 1, what is the value of a discontinued car? And again here, what I can think of is that if I think about Toyota, even if it's discontinued, that car will keep a lot of its value for a long period of time because those cars are indestructible. Then take some American car which I shall mention, like even before discontinuation, it was already a crappy car. So maybe the value of a car at any point in time depends on the number of cars in circulation there. It's the stock of cars that matters there. And that's something you could actually estimate in the data that you have. So what, at any given point in time, for some depreciation rate, what is the value, what is the stock in circulation? And that might depend on the value of the current car. Second question. A certain type of model gets discontinued. I'm a buyer, I want to buy a new car there. I hear the news that this car is being discontinued. What do I do now? I can still buy the car, second hand. Or maybe because I have some suspicions here, I want to buy another car. What's my closest substitute here in this case? And so that's actually something that you can do. Is there any spillovers there? That if people shy away, or if the buyer composition type changes from slightly low income to slightly less low income, or the other way around, is there any substitution patterns in there? And the third one is that maybe take a different perspective here, is that manufacturers don't discontinue cars just in isolation. I mean, they're not the buyers of Twitter who make all sorts of arbitrary decisions there. Hopefully some of these decisions have been thought of. So if you take that, what is the typical car manufacturer? They have a portfolio of cars. And they market this portfolio of cars for high income, middle income, and low income. So they have segments there, and they market these cars in these segments. So if they discontinue a certain type of car, what happens then? Do they expect that people switch to another segment, or do they replace this with another model of car? What happens in that decision? It's a portfolio decision for there. So do they replace it with a new type? Is there anything that you could learn from that could be used to tease out in there? And then another type of, once in a while you get these callbacks of that the brakes of a Toyota don't work and that they only to come back. If the discontinuation of the type of car has already implications for the value, I suspect that callbacks also have something for the value there. So maybe you could use that as another type of shock in here for the value of the car to tease it out. Okay, now in the final 0 minutes that I have left, let's take a bit of a higher macro perspective here. So here I have the unemployment rate in the United States from 1993 to 2019. So that's on the left axis, and then the blue lines is taken from the paper. This is the fraction of all the discontinued cars in the data. When are they being discontinued? This is not a random pattern. So what you see here is that there seems to be more cars discontinued after the recession of 2001 into 2008. And this is an understatement because I did not even include the car manufacturers that discontinued all the cars which were more up here there. And so again, if you think about this in terms of, say, what is the decision for a car manufacturer to actually discontinue a particular type of car, they probably look not only at the portfolio of cars that they have, but also at the market conditions. And the market conditions are very susceptible for lending conditions that people can buy these cars, but also the demand for cars that depends on the macro circumstances here. Now, full circle back. This library started out in the introduction with high-income people and low-income people. Now, qualifying, almost everybody in this data set is low income. You have low income and a lot more low income people. So we have low income people in here. They need cars there. They need to drive a car. Now what happens in terms of macro conditions? Well, in terms of macroeconomic conditions, it's a shock to say your permanent income there. If you have a shock to your permanent income, or an increase in your income variability as a poor person, it gets more difficult to actually buy a particular car. You need to come with a down payment, you can pledge less as human capital there. So that's an interesting perspective there. So let me, one final corollary that I could think of is that maybe you can find a data set with what type of cars do unemployed people buy? Are they more likely to buy a discontinuous car or why not? So thanks so much for the opportunity to participate.
Thank you very much for the discussion. This was very useful and helpful. I think you're 100% right that I actually like the way, I don't know if I'll use Lemons Buying Lemons as a new title, as you know, we keep changing the title. But I like the thought of actually using that as an interesting case to say this is an experiment among a set of borrowers that we already are very concerned about, and kind of not using that rather than as a bug of the data, but using it actually as a feature. So I think that's actually a really interesting suggestion and something we can definitely think about. Just real quick, so I think an interesting point when you're thinking about discontinuations and the decisions of the dealers is that virtually all of our data is secondary market, right? So it's a question of how the dealer is thinking about it. They discontinue a vehicle that changes the primary market for the car, and then how does that have spillovers into the secondary market? I think is something interesting to think about and explore. We haven't probably thought through all the intricacies there, but I think that's something useful to think about, this primary versus secondary market thing, because virtually everything we have is used cars in the sample. There's a couple, and we do things where we drop the new cars, and it's very small. So. But no, these were very helpful, so thank you.
You have more questions?
Very good.
I'm wondering if you could use like the heterogeneity in collection rules based on like at state levels, and that could give you like more variation to just provide more evidence consistent with the mechanism that you have.
Yeah, so we've thought about that. The one issue that we have is our sample, the changes in the state rules are all pre our sample. So we wouldn't have any states that can have changes pre and post, right? So we wouldn't be able to look at control for any existing state factors before and after. So we could do it just with the interaction term.
Yeah.
But the issue there is that any differences in the state, you're attributing to that rule change, and that seems like a very strong assumption to make. So we did, full disclosure, we did run that. We did see, that would really affect the down payment result in the way this is set up. We did see that it did have an effect on the down payment, but we were very dubious thought that there's lots of other stuff going on. If we had a change that was, in our sample period, it would be perfect, because then we could run the standard triple diff on that. But we don't have any state law changes in our period. Other questions, or I don't want to keep people, I know people might have flights or drinks.
I'm just curious, you said you ran stack regression, the results are similar, which is good, that's reassuring. But also when you run the stack regression, you can actually look at the cohort-specific results. Do you see heterogeneity in the cohort-specific results? In the graph that the discussant showed, it was non-random, the timing of these things. So you could actually look to see if there was differences in the treatment at different times.
Yeah, so I don't think I run the exact specification that you're thinking of. So I think you're thinking of interacting the treatment effect with the cohort-specific fixed effect.
Well, so you run it. So it's treatment. It's one cohort versus never treated.
Right.
And then another regression is one cohort versus never treated. And what the stack regression will do is that there's different ways of weighting those different things to get kind of an average treatment.
Right.
Which is you can either do the two-way fixed effects or the Sun Abraham. There's different ways of doing it.
Yeah.
But you can also look at when you run a cohort specific. specific, you can actually look at what are the estimates per cohort.
Oh, this is
And
like the
you can
due date
actually-
chart where you show basically
Exactly,
your
yeah.
your estimates each cohort
Yeah.
of your treatment effect.
And so is there a correlation in what those treatments are looking at relative to, say, timing a recession and those kinds of things?
Yeah, and that I think we'd get after this if there's any differences across the year. I think that would be interesting either way that it goes. If it was difference across years, this could answer, what are the interacting effects there. If it's similar across years, then, we could say, oh, it's similar across years. But no, that's something we can run. I haven't done that. We've done just the basic stack, but we haven't run it split out.
But as a starting point, the fact that if the stack regression is similar is a good sign.
Yeah. Okay, any other questions? Happy to.
That's
Well,
it.
thank you
Is
again.
it a wrap?
Yeah.